Hi, I'm here with Dr. Peter Linneman, who is the founder of the Wharton Real Estate Center, which is called the Zell-Lurie Real Estate Center. I think you taught real estate at Wharton for about 34 years?
Well, I was at Wharton for 34 years on the faculty, and I taught real estate probably for about 25 of those. I also taught finance and statistics and investments and a lot of other economics, a lot of other things. But it was a very nice career.
Wonderful.
And I had some interesting students.
Yes.
You're here as one of my interesting students, and I might say we're here today in Nairobi, Kenya, on an annual expedition that I do with some friends, and you're here. I've got another former student joining me, and I've got a number of my students from Kenya here, so there's a nice circle of life here. We're very casual as a result of that, but
Absolutely.
education is the theme.
Yes, education. And the great thing about Dr. Linneman is that he's not only a great educator, but he actually went out and did this himself in terms of real estate investing, in terms of real estate advisory. You have a few different companies.
I've had on the non-education side, although in a funny way all of it's education for me and others. I've had an advisory firm for about 40 years called Linneman Associates, and we've advised individuals, high wealth, sovereigns, corporations, private equity on strategies or particular situations over the years. We have a vehicle called the American Land Fund that invested in raw land for development. We have KLR Realty, which has done boutique types of investment. I've served on the board of about 20 public companies over the years. Probably the most famous, only because it was in New York, was Rockefeller Center, which was a REIT, and we owned about 6.2 million square feet after a long, complicated structure in the mid-90s. I was chairman of that. And a bunch of private kind of exercises as well.
Great. And so through these years, you've taught thousands of students about real estate entrepreneurship, investing in different real estate markets, real estate development, etc. Throughout these many years, what have been your most important lessons that you feel like you've passed on to your students who have gone out to invest in real estate?
It's a great question. First of all, I counted that I taught about 3,500 students. Or I would use a different word. I tried to teach 3,500 students. I'm not sure if I taught any of them. Interesting, the most important thing I think that the ones who got it really figured out about real estate investing or investing in general from me, which is it's an art rather than a science. That you use mathematics in it, but it's not mathematics. It's a lot about experience and judgment. And I chose the title of a book I wrote, Real Estate Investments and Finance, Risk and Opportunities. And that was really the message I tried to deliver. I actually chose that title intentionally, which is there are risks and there are opportunities, and they change over time. And what one party may find worth the risk in light of the opportunity, another party may say, I understand the opportunity, but it's not worth the risk. And you can imagine an old person and a young person going through a difficult path to something quite nice. The young person might say it's worth the hassle. And the older person may say, given my situation, it's not. Same objective at the end, and one chooses and one not. And I hope that what I got through to students is it's not mechanics. It involves analysis, but it isn't just analysis. And I think if I had to sum up one thing, it'd be that. And the second one, you took my classes, I would hope that I was able to communicate that there's a right way to do business and a wrong way to do business. And I don't mean do ABC, on how to carry yourself over a career and how to behave or try to behave. Try to behave is probably a better than behave. None of us reach our objectives that way. And so I guess those would be the things.
Okay, great. And So the average person listening is probably somebody who hasn't had too much exposure to real estate. They're probably working a 9-to-5 job in middle America or somewhere in Europe, somewhere in Asia, but they want to go into real estate.
Yeah.
They want to have some exposure to real estate. What would you advise them? What could be like the first steps to take?
This would shorten in the interview if I said don't do it, wouldn't it? That would really shorten it a lot. Look, the first step is, if you want to play a guitar, is you get a cheap one. You don't, if you think you may want to play the guitar, you don't go out and buy a Les Paul original guitar that costs $50,000 or $150,000 because it was his guitar. You go buy a cheap model because you aren't sure it's really going to work, and then you practice, you get exposed to the best people you can find to try to learn. And I think there's an analogy, and then of course as you go, you get better and better, and you get exposed to maybe a better instrument. And I think that simple analogy probably applies. You started out as a student, you went through some books, you listened, you worked with your fellow classmates, you tried, and if you think about it, you thought it was expensive, but actually it was cheap in the whole big scheme of, gee, I go out and buy a building for $1 billion. That's expensive, right? Buying a book or spending some time in a lecture or watching some videos is cheap. You try to get better at it. You try to find somebody that you can learn from. I don't generally encourage people to go out and just buy it on their own because it's a bit too complicated the first time, but find somebody who's doing it, shadow them, work with them, work for them, find a way, and then you move up. You didn't become Eric Clapton, the guitarist, the first time you picked up a guitar.
Yeah.
And you didn't have a classic Fender Stratocaster the first time you picked up a guitar. That's probably the best way to do it, a little bit at a time. And you know, you find a class, you find a book, you find a person, try to learn from them.
Okay, great. So who are some of these people that you would recommend besides yourself? I know you're friends with a lot of very
people.
Successful.
I learned. It's interesting. I didn't get into real estate until I was about 34, 35. I was trained as an economist by some very extraordinary economists, most of whom are dead at this point, but a number who won Nobel Prizes in economics, and I really tried to learn everything I could from them. And then I was doing finance and economics, and then the opportunity came to do real estate, but I didn't know anything about it. But I knew I was good at learning. And in a way, that was my skill, is I was good at learning. And so when I learned economics, I tried to expose myself to Milton Friedman and George Stigler and Gary Becker and to Jim Heckman, these people who knew tremendous amounts. So when I got to the real estate side, I had a platform at Wharton where, because I was a professor at Wharton, some people would at least take me sort of seriously. So I got the opportunity to learn real estate from people like Alfred Taubman and Mel Simon and Mort Zuckerman, and who were very kind to me. Most of them of that generation are deceased now. They were very kind to me, and you'll find that most people are pretty kind to you if you are moderately humble about what you know and you're willing to work with their schedule. Today, the people who I admire, there are many people I admire. I mean, they range from young people, or at least people I consider young. That's a better way of saying it, like Jeff Blowett, related, who was a former student, and John Gray, who came out of Wharton, who's at Blackstone, who's extraordinary. There are guys, John Schreiber, most people haven't heard of, but is one of the best human beings and one of the best real estate people I know, and was the original Blackstone real estate partner. Sam Zell, a lot of people have heard of, extraordinary real estate people. There are many of them that, and interestingly, as you know, we were in a conversation yesterday, many of them are not known.
Yeah.
There's a difference you have to make between people who are very good at a profession like real estate and people who you've heard of. some of the people you've heard of are every bit as good as you hear, and others you've never heard of are also very good. And there's some you've heard of that aren't that good. And so there are a lot of people to learn from. People I admire personally are people, I guess, that were kind enough to teach me, a guy like Ben Lambert at East Still Secured, or that are still alive. Ben Lambert at East Still Secured, or Peter Bedford, who was at Bedford Properties, or Sam Zell, or, as I say, Al Toppin and others who have passed on. So.
Yeah, okay, great. And to those who are watching, one of the books that really taught me real estate was Dr. Linneman's book, Real Estate Finance, Risks and Opportunities. We'll put a link below so that you can go out and purchase it. I highly recommend that you do that.
We just have a fifth edition of it out, with a former student joining me to try to bring it into the 21st century in terms of its technological linkages and so forth. So we're just around a month or so.
Bruce Kirsch.
Bruce Kirsch, yeah, great guy.
Great guy.
And in fact, just as a pause, if I might, as you can see, there's a theme in my life of, as you know, I have many friends, some very intimate, some not. There's a lot of the 3,500 students I had who I had and I enjoyed and so forth and went their own way, never saw again. But as you know, there's a lot of students who are now in their 50s and down to their 20s and 30s. And I feel blessed that I was able to make a connection and keep a connection with people like you and Bruce and others. It enriches my life, and in an odd way, it doesn't keep me young, but it does keep me focused on what you guys are doing rather than what was done, which is a different dimension.
Yeah, absolutely. And you've had, incredibly successful students such as Ivanka Trump, and so many.
Yeah, and I don't claim that anybody's success was due to me, because if I did, the guy who gets carried away in handcuffs, I'd have to, take credit for that too. So, but I do think that one of the beauties of education is you get people at a certain point in their life where they're more open. And what I enjoyed and what I actually think I was pretty good at was the same thing a really good basketball coach is, which is, I don't know that I can make you smarter, but if I can tap in to you turning yourself on to learn. And that was the real joy, and that was, and I, had some success that way.
Yeah, great. Going back a little bit to real estate investing, let's say if you had today $1 million, so maybe not the typical person looking in.
Is that's all I'm supposed to have, or I'm allowed to have more in life?
You're absolutely allowed to have
I have
more.
a discretionary million. Okay.
And I know you have, you've been incredibly successful, both in academia and professionally, but, average person looking at seeing this video that has $1 million and that wants to do perhaps a little more advanced real estate investing, he went out, he flipped, or she did, flipped 2 homes, they were successful at that, multiplied their money. They're looking to take the next step. What would you recommend?
I'd step one step ahead of yours, where you said they bought a home or flipped or whatever. I'd say actually, if you're in a country like the United States, where there are some very good REITs, real estate investment trusts, I'd actually recommend your first step might be to invest some of that $1 million in them and then follow them.
Okay.
Follow Federal Realty to find out what they're doing well at with their shopping centers. Follow Simon, what they're doing well at with their shopping centers. Follow Boston Properties and follow it. And you're in it, and the fact that you're in it kind of is a motivating to follow. Then at a personal level, you probably suggested the right way. Buy a 4-plex apartment complex. You're probably not going to end up with a 4-plex apartment complex, but find out that tenants skip on their rent. Some of them destroy the apartment. Better to find that out with a 4-plex than a 400 unit, and have all your money at risk. Find out that the plumbing does break on Thanksgiving Day, and you got to deal with it. Find out how to collect the rent, and report to taxes. As you get to the kind of number you're talking about, if you were to do real fast and you have $1 million, you have in real estate the opportunity to do about 2 times that in debt. So you have the opportunity to buy a $3 million property. There's another way, which is you could find somebody else who's got $1 million who you think you're emotionally compatible, because you're going to be a partner. Partnerships are hard. Everybody thinks partners. Simon and Garfunkel, there's a reason they broke up. Beatles, there's a reason they broke up, right? Partnerships are difficult. But if you could find somebody compatible, and there's many great examples of this, you could take your $1 million, get their $1 million, and now you have $2 million, so you can do $4 million in debt, $2 million in equity, you can get a bigger property. And you step up. And what I would do is to take your point. If I had $1 million, I would think, what can I borrow $2 million for? That's the best possible asset. The best. The best neighborhood, the best physical, the best people that I could get for $3 million. People tend to say, let's get the worst. And you're not at that point really set up to solve. We were across from a museum yesterday, and we were joking about, I don't think I'd start my career with that building, even though this was a derelict building that's been abandoned as construction for about 3-4 years. You might pick it up for $3 million, but if others haven't been able to solve it, and it's your first time. So find something that's the best and get it, and then your $1 million becomes $2 million, and then you roll.
Okay. So you mentioned a few important things there. So the first of all with REITs. Okay, so you mentioned some really good retail shopping. REITs. What other REITs do you think that you'd recommend as you look at the entire real estate space?
Look, I'm not a trader. I'm not a flipper. So what I'm not saying is do it and then tomorrow sell or a week. So, but I'm kind of Warren Buffett-like, which is you want good things happen to good properties over time, and good things happen to good management over time. So I tend to look for, whether they're public or private, good management and good properties. And will bad things happen? Of course, but more good things will happen. And so companies like Prologis, Federal, Regency in the shop, Taubman, Boston Properties, Paramount Group, Host Properties, Hersha. I'm not trying to limit it. There are some companies I would never give my money. Not because they're dishonest. I'm not going to steal it. But too many bad things happen to bad property. And too many bad things happen with weak management, even when they're trying to do good. They're working full-time to do good, but they're just not up to the task. If you ask me to guard LeBron James, I'm not up to the task, right? You wouldn't bet on me. So what I would say is look for good management with good assets if you're going to just be an investor.
Okay, great. And now that you're mentioning, these good assets, what would you define specifically makes a good asset? Because obviously, there's so many articles out there, so much information about location.
Sure.
The location is the most important thing.
If I can have a location, it helps. The only problem with location is it can change over time. And there are many famous examples. Canary Wharf was a completely derelict area, and now it may not be prime, but it's a good area.
Yeah.
And you always have to bear those examples in mind. Downtown New York was once the New York, and now you think of Midtown and those areas as more the prime office spaces. So locations can change. But I think the key to understand about location, avoid the mistake of getting a property that is close to everything but near nothing. And that happens a lot. Shopping centers. I'm only 2 blocks off the main strip. And it's only, a block away from the big store. A block may as well be a desert, right, in a product like that. Because nobody's going to be walking down the street and go, I think I'm going to walk a block or two or drive a block or two off the. So what you really always have to ask yourself is, yeah, I know it's close, but is it really near? And if not, you're not going to change people that way. Give you another example. I always like to take retail because it's so obvious in this, which is, and this was a lesson I learned from Al Talbot, who was a real estate genius, which is you cannot buy retail cheaply enough to make bad retail succeed. If people don't want to shop there in that location because of the road layout or the design or whatever, you're not going to make them. And the reason is, no matter how cheaply I buy that shopping center, I cannot make the rent low enough to change the price of Wheaties. And if I can't change the price of Wheaties, nobody's going to come, right? And that's what makes product like multifamily and industrial a little easier. Because if I buy it cheaply enough, I can reduce the rent that unless it's horribly located, people will come. And you have to work backwards that way. So I think what you want to do in terms of location is, there are a lot of people, including me, who have lost money by assuming the location will come to me. As opposed to, I'm not going to live that long, why don't I go to the location and pay up and be there? Now, you don't have to be in. There's only one building that's the prime building. So location matters. Other things that matter, design. Design matters. Operations matter. Real estate, not counting hotels, which is really an operating company that happens to use real estate. If I have the best location and the best designed hotel, best location, the best design, and they spit at customers as they come in the door, it's going to be a failure as a hotel. That's less true with a warehouse, right? I mean, warehouse is more real estate in the sense that the dock workers can be rude, but if I got a great location and a great physical box, it will, better that they don't spit at them, but nobody's going there for that. And you can imagine the continuum. So figuring out what makes a product work, what makes location. Biggest mistake most new people make is they don't see enough mistakes. You know, it's like no different in life. If you go out, you heard this as a student, you should, every property you're at, the property you're at, you should look at it and say, what did they do well, but what is wrong? And then ask, why is it wrong? And how could I have fixed it? Or could I have fixed it at any reasonable cost? But ask why. And you'll see that my favorite example was a building built in the heyday of money. Money was available for everything. And a guy had done warehouses, and he had done it pretty successful. And he decided he was going to do an office building, 3-story office building, suburban building. And he had a design guy, a simple little architect guy, who had done his warehouse. It was a pretty simple product, you gotta do it right. And they designed an office building, and the windows were about 1.5 feet too high. Now you say, how does that matter? It matters because you don't notice it when you stand. When you stand and you walk the building, the windows look fine. It was when you sat down at a desk and you noticed the windows were 1 foot too high. That was just a design mistake. The developer didn't know what he was doing on that type of product, and he didn't have a designer who knew. They were all trying to do a good job, and that's forever a cursed building, even though if you walk it, unless you have a good eye to it, you won't catch it. Find those kind of mistakes and learn, because there's so many lessons out there.
Yeah, some really great advice there. And then another lesson, and also final question for you, but another lesson that's been very evident for me is, and this is both as a person starting out, and then the most sophisticated and the best companies out there that are in real estate, is the issue of debt.
Yeah.
Right, and there's so much conversation, there's so much research on, and I know you have done a lot of research. What do you think is the right number to use when you talk about leverage?
I always have thought people have misfocused on debt in 2 ways. One is there's no free lunch. Milton Friedman was one of my professors and is famous for this notion that there's no free lunch. Anything you get, there's something goes with it. And by the way, we both know that if things go right, you'll always wish you would use more debt. Because if there's only upside and things only are going good, you wanted that fulcrum to really do. The thing we forget is when it goes badly, all the complications of a debt document, first of all, just the document itself has a lot more complication than an equity document, right? Make it more difficult because now I have to get permission and I have to get your attention and why would you do it and so on. And then the economic effect of debt when things go bad, right? And therefore, I've always said, I'm first in the real estate business, secondly in the finance business. And I think a lot of people view themselves in the finance business rather than the real estate business. And therefore, my debt levels have generally been 10 to 20% lower than what others have done. Have I made less on the upside? Absolutely. Have I got more money around on the downside? Absolutely. So I made some land investments where I'm going to have lost money. But if I'd have levered them, I'd have lost all my money. And there were a whole bunch of people who bought the land with a lot of debt, lost everything. I lost because things didn't turn out as I thought because of the housing market, but I didn't lose everything. Yeah. And so the second lesson is focus less on loan to value, which as you know is a very popular thing, and more on debt coverage, more on cash flow to cover. Yeah. And ask yourself, if I go back in history and look at things, if the worst drop occurred in my cash flow, will I still be able to pay my debt? I'm not going to be happy, but will I still be able to do my debt? And basically, if your debt coverage is like 1.05 times, you have 5% more cash, and that's at a good time. 5% more cash, you know you're not going to have a cash. And none of us have ever lived through a world where sooner or later we're not going to be wrong by 5%, by 10%. And in real estate, as you know, especially like office buildings where one tenant leaves and you lose 30% of your cash flow. I think the focus on loan to value is mistaken. I think the real focus should be on, do I have 40% cushion in an industry, in a sector where 20 and 30% drops in income are typical. And if you don't, you're over-levered. Because you want 10%, 15% cash flow coverage versus the worst. And what would I use as the worst? I'd use 2008, 9, 10 as my proxy. Could it be worse than that next time? Yeah, but that was a pretty bad one by historical standards. The next one could be worse, but if you were doing a hurricane, you'd take a category 4 and you'd say, or what was the damage that occurred? That's what I would do. Ask, do I have coverage if 2009 repeats itself? And if you don't, you have too much debt. And if you can cover with a cushion, you have the right amount of debt.
Great. Some really great advice. We really appreciate your time. And we look forward to speaking to you again.
Always happy to help, and I appreciate you being here with me.
It's a pleasure to be here in Nairobi, Kenya. Thanks, Dr. Linneman.
Thank you.
Thanks.